Hello, I'm Solène Honorine, and welcome to The Sound of Economics, the podcast brought to you by Bruegel, the Brussels European and Global Economic Laboratory that explains today's key issues for Europe and beyond. The response to COVID crisis necessitates a lot of cash. So will the upcoming green transition. But with Brexit, Europe lost its easy and practical access to the world's largest financial market. So is today the right time to create a European capital markets union with only one rule to ring them all, one rule to bind all 27 capital markets in the EU? To discuss it, I'm joined by Thomas Wieser. Hi, Thomas.
Hi there. Thanks for inviting us.
Thomas, you're the current chair of the EU's high-level forum on capital markets union and the former chair of the Euro Working Group. You recently published on Bruegel website a paper on the EU's post-Brexit reckoning with its financial markets. And your co-author is also with us today, analyst Rebecca Christie. Hi, Rebecca.
Hi, Solène.
To kick off our discussion, can you first explain what is at stake here? What did Europe lose when it lost the City of London?
I find that when talking to regular people about financial market issues, the numbers are abstract to the point where it's almost easier to think of them in terms of orders of magnitude. Small, big, really big, and super a lot. In terms of thinking about derivatives markets, the notional numbers, the top line number is so big as to be hard to mean anything for the people who are around. We include those numbers in our paper to give a sense of scale, that this is really a lot. This is a substantial shift. And this is something that will require a lot of adjustment in how people do business, even if they're able to make those changes without any major disruptions. In terms of what's at stake, one of the things that you hear from EU policymakers is that for a long time, the EU has been content to manage the assets, while the operational risk and some of the liabilities have been handled in London. London is doing the buying and the selling and the trading and the keeping track of. With the end of the UK being in the single market, the EU will have to decide which of these things are important enough that they need to stay in the single market, which of these things are financially interesting enough where it could really be an economic advantage to do them at home, and which of these things are hard and should stay with the specialists and are worth paying whatever little extra it might take to keep them where they are.
As Rebecca was saying, the reality so far has been that the big, large capital market of the European Union was in London, and we were happily consuming things and not facing too many of the risks. Because we in the EU 27 were not facing too many of the risks, we didn't have to put too much energy into supervising these markets, which 10 years ago led to a pretty bad impact in some member states. Because that was so, the UK representatives had a very large weight, had a very strong voice in how EU regulations were written, how our whole legal framework evolved. Now, the UK has drifted off somewhere across the channel. There's a strong presumption that they want to differ. They want to have different laws. They want to have different regulations. They don't want to be bound by the European Court of Justice. And all of that means that we will not have equivalent rules over the medium term. And if we don't have equivalent rules, all of a sudden you can't trade in goods or in services as within a country or as within an internal market. In extreme cases, it is like trading between, let's say, China and the European Union, unless we find different solutions, but at present, this doesn't look like it. So firms will have to decide, do they want to move back into Europe? Will they rely into the European Union? Will they rely upon such an equivalence of rules that they don't have to relocate, but are making a bet on being still able to trade, or will trade in certain products, in certain services, stop altogether? What are the effects? Products will get probably more expensive, both in the United Kingdom and in the European Union. Choice might be a bit lower, and quite a number of firms will continue to be relocating from the United Kingdom into different countries of the European Union.
Has there already been some winners in Europe?
Because the markets have had 3 years and counting to adjust, most of the obvious areas where you could have a big operational shock have been addressed and taken care of. Say credit ratings, for example, for the EU to count your credit rating towards a lot of important regulatory things, you have to have a credit rating that comes from within the EU. Okay, so now all of the different credit ratings firms have had to set up little offices in the EU that can take the stuff that comes out of London and bless it with an EU endorsement so that can be used. This is happening across the different sectors that make up the financial industry and has gone a long way toward preserving financial stability, which is what we're hearing from the big regulators right now, from the European Central Bank and the Bank of England, that at least from a financial stability perspective, we're not expecting any big shocks. In terms of winners, there hasn't been a single city that has absorbed all of the new jobs that are being created. London's gotten a bit smaller. Dublin has picked up a bunch of people. Some firms have moved to Frankfurt. Some firms have moved to Paris, a few to Brussels and Luxembourg, but there hasn't been a whole new city that sprung up out of the ocean overnight.
So does that mean that we will go from a situation where we had one giant city dominating everything to little Asterix villages a little bit in Europe with a very segmented financial services everywhere?
It probably won't be that fragmented. These are all major cities that had financial industry hubs before. Also, we have the internet and we have a very sophisticated ability to communicate worldwide, not just within the single market. What it does mean is that there will be more fragmentation of regulatory rules. There are some things that are supervised at the national level, some things that are supervised at the EU level, and some things that are supervised on a more or less global level, depending on how you look at the different really global standard setting bodies. So you do have more fragmentation in terms of the rules of the game and how people play. And that means more work for the compliance and legal department.
Thomas, you were explaining that in a way, all the expertise was in London. So not only the people who are working on the financial market, but also in terms of regulation, in terms of politics. So can we say that this is this expertise, this strategic vision that has been lost?
So far, European politicians have washed their hands in a way of having to think about how to regulate their financial markets. They have been able to push very much of that thinking into London, into the United Kingdom. And now the big question for them is, will they be importing products, processes, and so on, which are more or less produced under UK law, and which then enter the European Union, or do they want to onshore a certain part of financial markets? And this is a project which we have embarked on over the last half year, and very recently produced a study for the European Commission on how to make the European capital market work. And very much of that is about convergence of rules, which at present are not fully harmonized. It is about making supervision more efficient and the practices of supervisors more equivalent to each other. It is about making rules more simple where they are complex, getting rid of unintended consequences of previous legislation. And just to give you an example, for newer sectors, we also propose to create one single framework for, let's say, digital assets for the European Union, for the 27 members as a whole, and not have every member state developing rules of their own. And in 5 years, we'll have sort of a kitchen garden with 27 slightly different or largely different sets of rules. And that would make mutual recognition, that would make trading, and that would make investing that much more difficult. Just think of the average student who's been buying bitcoins over the last couple of years. He or she will need to know one set of rules and not 27 different rules. The more this is harmonized, the more efficient we get, the cheaper it gets, the wider choice gets.
Thomas, one thing that jumped out at me in the report was your finding, or the report's finding, that the countries with the best funded pension plans were also the ones with the best markets. Do you think that's a way to capture politicians' interest, to say, look, if you have better markets, you also won't have to raise as much money to fulfill the promises that you've made to your people?
The question is not if there is a correlation, but the question is that of causality, probably. My belief is that countries with a large pension fund industry and a large part of pensions funded privately, say second pillars, third pillars, automatically generate a higher equity culture and a deeper and more vibrant capital market. And it is very difficult to imagine a country which relies nearly uniquely on the first government-funded, taxpayer-funded pension system to have a strong and vibrant and deep capital market. Very difficult. If we look at developments forecast over the next 20, 30, 40 years, and if we want to make future generations receive similar pension payouts to that which the retired are already drawing down now, then we will simply have to move into second pillars. We will have to move into third pillars, even in the more reluctant countries, and that will boost capital markets nearly by itself. But then we have to make sure, one, they are well regulated. We have a very well functioning system of consumer protection, and we need to make sure that the 27 small or medium-sized capital markets become more like one capital market, because for Germany and for France, you may think it's fine. Yeah? Large countries, large population, lots of savings, lots of choice. But what about the smaller countries like Belgium, Slovakia, Slovenia, Finland, and others? There, the market is too small, and you want to be able to reach out across the borders. That you can only do if you have one set of rules, well-functioning consumer protection, well-functioning investor protection, and good supervision.
How do you estimate the political will of actually creating this one set of rules?
Over many, many, many years, I've heard very, very good things being said about producing such rules for European financial markets, for European capital markets on Sundays, when politicians were giving sort of nice speeches. The one thing they forgot when they went back to their office on Monday morning was to tell their negotiators, hey, I said something nice about producing convergent rules and a true European capital market on Sunday. So during the work week, you as negotiator should be following my very good example. They just forgot to tell them. So what happened? The negotiators went out and negotiated the continuation of market barriers between the different markets. We hope that this can change, but it needs strong political will from the very highest level if you want that to trickle down to those people then who are actually doing the nitty-gritty rules.
Is it a problem of culture, political culture? Is it a problem of not having too big an incentive right now?
You have a real case where when it comes time to negotiate, the instinct is always to play defense. What do we have that's benefiting us? What will we lose if we give up our national control of this kind of fee or this kind of disclosure or this kind of tax treatment? That plays off against sort of the general goodwill to do something all together. But of course, everyone wants an all together that leaves their own particular pet project largely untouched. Getting past that will probably require some sort of external push, whether that's competition from across the Atlantic or across the English Channel, some sort of financial crisis, Or maybe just a general shortfall. That's why I was asking about the pensions. If people realize that they can't raise taxes fast enough to pay for their aging populations, maybe that will give politicians a push to think a little bit more collaboratively and a little bit less defensively.
I was going to give two more possibilities of what could incentivize politicians to move forward. One is intellectual enlightenment. So maybe that works, maybe it doesn't. And the second one is the present pandemic, the recovery as we come out of this recession. And very many countries, especially Western democracies, are throwing a huge amount of money at the economy, at consumers, at investment, and rightly so. Will that suffice, even though we're talking about very large increases in debt? Will that suffice in order to move our countries, our economies out of the doldrums of 2020, 2021, 2022? And the answer is clearly not. Taxpayers' money alone will not suffice. So what we need to do is to harness the savings in our economies and put them to good use through capital markets. Put them into many of the projects that will be underway, hopefully, by later this year and next year. But it is not only the economic recovery after COVID, it is the ecological transition, which will require lots of taxpayer money, but also here, it'll not be enough. You will need private savings transformed into projects that are worthwhile and that will move us forward in the process of the ecological transition. So all of these factors together show that we're doing the necessary thing now with the fiscal response to the crisis, but we're not doing the sufficient thing yet by harnessing the might of hopefully better organized capital markets to get us onto an economic path where our countries are growing again and employment picks up strongly and productivity is better even than it was before the crisis. So the two things together, they'll work. One by itself will not work.
But that's quite a conundrum, right? If I understand correctly, we really need to have efficient access to private money now because the need is now, but the regulation is not in place. And that's right at the moment where the big financial market that was part of the EU is suddenly moving out of the borders.
Well, it's not as if capital is not here yet and there are not fairly well functioning national capital markets. But the sooner we can bring them closer together, the sooner we can make each of them stronger and more vibrant, the better. And that is why politics needs to start moving now in 2020. And the transformation of the legal framework and supervision would have to start being rolled out already in 2021.
So would you view this crisis a little bit as the occasion that led to improvement in the banking union after the last crisis? Do you think this crisis could spur the same momentum for capital markets union?
For right now, we haven't seen finance at the center of the crisis. What we have seen is fiscal policy step up in a way that it really wasn't able to in prior crises. We have, for the first time, a proposal for a large-scale European Union level publicly financed recovery initiative that has been endorsed by France and by Germany. We have seen in Germany itself a massive, massive fiscal response in marked contrast to German efforts to pay down their debt and stay out of capital markets entirely. So this turn towards spending and this turn towards considering joint debt, it hasn't happened yet, but it's a lot closer to coming into being at scale than it ever has been before. This is a really big development. My hope would be that as the EU gets more comfortable borrowing on markets and cooperating on markets, it becomes more interested in regulating together on markets and making these incremental changes that together add up to a much smoother and faster growing economy.
What would you say could be the price of not moving?
Slower growth, higher fees, fewer resources for ordinary investors. Right now, whether you can buy a mutual fund in Europe depends a lot on what country you're in and not how much money you have. These are all things that could be changed, that are changeable, but because of the way people are used to doing business, they're resources that we don't always have available to us right now.
I'll just give you an example. I was working in Brussels until early 2018, and then I pulled my pension fund money out of my Belgian bank, transferred it back to my Austrian bank, went there and said, look, I'd like to invest this in very specific government bonds and funds that I think are a good investment. And the people there looked at me and said, oh, well, I'll have to ask. And they got back to me a week later and said, I'm very sorry, we can't source that. And I said, that's easy. And they said, well, not here. So for quite a time, I left my money in a savings book. And given where inflation is and where interest rates are, it steadily lost money. So having to rely on traditional banking products is very, very bad for consumers. It is very bad for sort of the average guy like you and me. So we're not talking about rich investors who've got millions floating around. This was just part of my pension fund. And because the Austrian market and the German market and the Italian market and the Belgian market and the Swedish market are still to a significant extent segmented from each other, we suffer the consequences of less choice, higher prices, and thereby our retirement income simply is lower. So that's one of the consequences. And if we move forward and if we manage to get our act together, this will be better for Europe, and this will be better for the average people like you and me. More important for you because you're much younger. This is not about the billionaires of this world, and this is not about the BlackRocks of this world. They can trade across borders at will, and they've got subsidiaries wherever they need them. But I don't have a subsidiary in London, and you don't have a subsidiary in Austria. So let's make having subsidiaries not necessary, and let's try and be able to trade across borders like you would be able to shift savings between Idaho and Massachusetts.
I guess the 2008 crisis gave a really bad rap to finance. A certain segment of the population can see it, as you were saying, it's the problem of the very rich, and this is actually a source of the problem. When you're arguing that created capital markets union within Europe is something that would actually protect the little guy, if I can say it like that. Is that correct? And do you think that's the argument that can actually push the debate?
That's absolutely a way to look at it. We started this podcast talking about the derivatives market, talking about high finance, talking about these incredibly abstract numbers. Those are important, but they sort of make up the air and the water of the financial ecosystem. The part of it that will benefit the most from a better functioning capital markets and a capital markets union within the single market is the part at a much smaller scale. The extra fees, the inconvenience from not being able to do certain things from certain jurisdictions. This matters a lot more to people who have human scale amounts of money at stake instead of incredibly abstract amounts of money where if you have to pay another fee, you don't really notice. Looking back to 2008, there were so many factors in play there. You had the initial crisis that came out of the United States with subprime mortgages, which had been magicked into complicated financial instruments, and in turn had been purchased by people, including people in Europe, who thought they were buying something safe when in fact they were not. One of the things that Capital Markets Union can do is increase the sense of safety by increasing disclosures, standardizing disclosures. The terms mean the same things to the same people, and making sure that all the information is in one place. Thomas's group's report calls for a single access point for information on financial products. It calls for standardizing who can get what information and how it can be. And it calls for financial literacy so that people will be comfortable if they choose to look for these investments. They don't have to come from years of working on the public policy behind this to know that it's not unreasonable to be asking for certain types of basic financial products for their pension beyond bank accounts. It's a great moment for change because there's so much change happening already. Brexit is happening, the pandemic stuff is happening. We see this giant fiscal shift and possibility of fiscal togetherness. When things are moving, it's easier to move some of the moving parts. When things are fine, it's much easier to start playing the small game and start looking very specifically at very tiny carve-outs and to have everyone's very specific concerns break down the negotiations. Right now, because it's a time of great change, it's a great time to set things on course for a better future.
Thomas, any last words?
Absolutely. Now's the time to move. If we don't move within the next couple of months, then we will be moved. So, time of choice, time to work.
On these parting words, I just want to flag that your paper and many others is available on our website, bruegel.org. Thank you very much, Thomas. Thank you, Rebecca. This episode of The Sound of Economics was presented and edited by me, Solène Honorine, and brought to you by the economic think tank Bruegel. Thank you for listening wherever you are, and let us know what you think on Twitter, Facebook, or LinkedIn.